Thank you for joining me. I'm Juan, lead trader and founder of ProsperiTrade. In this video, we're going to discuss day trading. And I'm going to show you how to take $100 and teach you how to buy helicopters, airplanes. No, I'm just kidding. We're just going to go over a few day trading strategies. And in particular, we're going to talk about Robinhood IPO and some day trading strategies that you could have applied for any IPO. So stand by for our video. So Robinhood was the big talk, the big anticipation. It came out on the news. It was highly anticipated to trade. There was a lot of controversy behind it because of Robinhood's recent history with AMC and not allowing trading. But let's check out the chart to see how Robinhood did on its opening debut. So it had a high of $40.25 and a low of $33.35, and it closed at $35.15 the first day. Second day had a high of $36.98, low of $33. So right now there's some support on 33. It's an early chart. It's not really technical analysis wise. It's hard to give technical analysis for a brand new IPO. But there are some big investors that are buying Robinhood. I saw an ARK investment. I mentioned ARK investment because it's so popular. I've seen a lot of blogs. I've seen other people that I respect buy into Robinhood. So for me, I don't invest in IPOs. So there's a great ad here on Yahoo that discusses how IPOs have done historically. So they talk about DoorDash, how it soared 86% on its debut, Airbnb, how first day was up 113%. But you want to look at long term. Is trading and investing in an IPO safe for the long term? They have a great statistic here done by the Dimensional Fund Advisors, and they found across 6,000 IPOs from 1991 to 2018, the average one-year return was less than 4%, underperforming the Russell 2000 by 2%. So this is one of the main reasons Buffett does not trade IPOs, and other great value investors, they don't trade, they don't buy IPOs. And actually Warren Buffett highlighted that in a meeting where he said an IPO situation more closely approximates a negotiated deal. I mean, the seller decides when to come to the market in most cases, and they don't pick the time necessarily that's good for you. It is more of a negotiated sale, and negotiated transactions are very hard to get bargains. If you take the houses in Omaha, you know somebody that lives next door to somebody who sold their house for $80,000 and their house is more or less comparable. They're not going to sell it for $50,000. It just doesn't happen. This is what happens in negotiated sales. So basically what they're saying, it's hard to get a bargain. It's hard to know what the value is because there's no history. For that reason, Warren Buffett doesn't invest in IPOs. I don't invest in IPOs either. But let's talk about Robinhood in particular, why I wouldn't invest in Robinhood right now anyways. So there's a few reasons. One, I don't feel their growth is sustainable. They had a great 2020, but it was mainly because of all the hype, all the meme stocks, COVID. There was nothing else to do but to day trade, to trade at home. Their majority of revenue comes from market makers. They say over 80% of revenue comes from market makers. And market makers do well off of Robinhood because there's so many buyers and sellers. The market makers make money off the spread as opposed to a larger traditional broker where there's the occasional buy and sell. So another issue is how regulated the stock market is. Some of the issues around market makers and the controversy, if by any chance they lose that source of revenue, that's over 80% of their revenue. I don't see how they can recover from that. Then there's more and more competition. I personally like Webull a lot better than Robinhood. Then the final thing is I use Webull. I don't use Robinhood anymore. I also have a regular large broker, a couple of large brokers that I trade also. Webull is more for the swing trades, the occasional option trades, just something if I want to share on a video, but it's not for a serious investor. So there's a lot of these investors, once they become more advanced, once they have more experience, they may not want to trade on Robinhood. So for those reasons, I wouldn't look at Robinhood as a long-term investment, and I don't invest long-term in IPOs. So what is day trading? Day trading is basically when you take a position And sometimes you sell in seconds, minutes, or hours, but it's usually within the same day. And there's a lot of strategies. I started my career day trading, and when I first started, I would record all my day trades. I would take an Excel sheet and document every day trade I did. Then I would categorize the market cap of the day trade that I took, the strategy that I applied, the float of the stock, the time that I bought that stock, my success rate. And I came down to a few strategies that I found to be the most successful and the most reliable and the most consistent for me. So I want to share that in this video. So if we take a look here in the screen, this is my actual chart, my actual broker here, and this is an actual trade I did. So one of the strategies, this is not the one I'm going to discuss now, but one of the strategies sometimes that I do, if it's a very high anticipated IPO, if it's an IPO that I'm willing to day trade, there are times that I'll put the ticker in the level 2 box. Whatever the estimated opening price is, if they say between 20 and 28, I'll set this for, let's say, $29 to buy 1,000 shares, and I'll just leave it there. And I have hotkeys, and as soon as it opens, sometimes I'll just scalp a trade. I'll take a quick day trade, a quick buy, because there's usually very consistently, there's always a good spike in the beginning, right when it opens. You see a spike, and if you have hotkeys set, where for me, if I press Control-1, I'm in position with 1,000 shares, and then if I hit Control-Z, I'm selling that at the bid. So that's one strategy. It's very high risk. It's riskier than some of the other strategies, but you have to know the right time to apply that strategy. If, for example, it's just been hot for IPOs, there was like when Airbnb and all those other IPOs, everything was spiking, then that's probably a week that I would have done something like that. Another strategy for me is the ABCD pattern. It's a pattern that I've been trading for a long time, and I have a lot of videos where I've actually recorded myself showing where the A is, where the B is, where the C is, and where the profit taking is for D. This is my video. I'm going to press play, fast forward a little bit. I saw this forming. I saw this initial spike, and that's usually the A. Then this would be the B, and it established this is the support. This spike here would be the C. I would be in position somewhere in here. So here, like, I got at $3.95, 1,500 shares. So which is this area here. Now, the good thing about it is you know where your exit is. 366 is my stop loss. If this thing, where I got in here at 395, if it dropped to 366, then I'm getting out. And my profit target would be the A here, this A here, breaking the initial spike. So let's fast forward. Okay, see, so I'm recording this video, and I'm recording my screen, and I'm showing where the A is, I'm showing where the B is, and I'm showing where the C is. So you see here, I was in the position already. I took a position, and the profit would be breaking out of this point here. You see D here? This is happening real time when I was recording this. And you see it broke this area, and then that's where you want to take at least half your position. And I think in the video I was just showing how I would document this, how my entrance, my exit, what was the float of that stock. So that's one example of ABCD. So this is another example here. I did a trade recap. It was an ABCD pattern. I'll kind of fast forward. Again, you have the A here, the spike. It dropped here. This would be support. This would be the B. This would be the C area. I would expect a pullback. And then, you know, the profit taken is when it breaks the position A here. Okay, see, so A, B, C. You also want to see an increase in volume when you're going up here in this area. Then D, the breakout here. And you see a breakout this point here. So you get in here. This is the C, kind of pulls back usually a little bit. Then you start taking profit here. Usually I would take a little bit more than half. And I would like to see D hold. I would like to see this support hold and this position, this area to become support to continue up. A lot of the times this ABCD, once it breaks the D, usually it spikes up a little bit more and then people take profits. You see here, it kept on spiking. So this is another video. I used the Fibonacci retracement, and I found that here it bounced off of, this is 50%. So with this strategy, I usually see a spike. If it doesn't retrace more than 50%, it's something that I'm going to look at. It's something that I'm going to put in my scanner. So I saw this. I have a scanner. It broke out. I saw it pulling back. When I saw that, it kind of dropped below 50%, but then popped right back above it, and it bounced off of it, and it bounced off of here. Then this is when you want to consider getting into a position. So you see here, my position is $12.09, $12.09. So went from $12.09 to 13. You see here, I bought at 12, 25, 12, 12.10, 11.86, 11.70, and I sold at 12.75. This is profit right here, 376. Profit is 564. I made 564 that day, and that was trading just a couple of hours of day trading. So this was it. So I saw the spike. This was the resistance. This is where it spiked. It retraced back to the 50% area. 50% became support. That's when I got in and sold it out here. Another strategy, but very high risk, is if a stock is hot and it's just climbing and going up a little bit and you just want to jump in it, at least jump in it when you see some sort of bull flag. So a bull flag is when you have an initial spike like this, then it pulls back. And as it's pulling back, you want to enter the break of the last candle. For example, this candle here broke this candle, meaning that it opened and closed higher than this candle. So this would be your entry. So now the good thing is, with the bull flag pattern, your stop loss would be the low of the candle. So this low here, if you got in here, it's not a huge stop loss. It's not going to break your bank. So you know where to exit. So if this goes up, if you jump in here and it fails and it breaks below this, then just take your loss. But you see it goes, and then it breaks. So you take your profit. This went from 74 all the way to $80 up here. That's day trading. You know, this is very popular in day trading, the bull flag pattern. And that's what they call it, the bull flag, because you kind of see how it forms. Kind of looks like a flag. And there's also a bear flag pattern, but we're going to discuss that in another video. So that was just a few patterns that I liked. And this is for trading IPOs. If we're trading regular charts, then there are other strategies like pre-market breakout, some momentum trading, different strategies that you can apply. So for an IPO, if I'm going to trade an IPO, if I really like it, if it's really hot for IPOs, then I'm just going to put the ticker in. I'm going to put a price in to buy higher than it's trading, just in case it spikes too quickly. As soon as it opens, I'm going to hit Control 1, Control 2 to get in 1,000 or 2,000 shares. I'm going to look for that quick spike that you consistently see with a lot of IPOs. So we'll look at a few examples before we close. You see here the potential spike, right? It didn't open all the way up at 40. It opened up here, 38, $2 spike. You have DoorDash here. It opened at its IPO at 182, had a high of 195. Airbnb opened at 146, high of 165. So that's just an example of a few IPOs. But a lot of times they open up and there's an initial spike. I like to scalp those if I'm day trading, or you can watch for a pattern, some sort of ABCD pattern, some sort of bull flag pattern, somewhere where support is established and you know where support is. You want to know where your exit strategy is. With day trading, it's not to get rich. You just want to scalp. You just want to take advantage. Small profits, consistent. You don't want to get too greedy, too emotional. So that was just a few points on how to day trade an IPO. I hope you enjoyed the video. Thanks for watching, and see you on the next video.